Okay, now let's try to understand about factoring without recourse, a real world example. So just to remember, factoring without recourse is like a scenario wherein you can see without a recourse, factor assumes the risk of uncollectible receivables. So the bad debts responsibility stays with factor, and this is without recourse. Okay, so let's see the example of Apple Incorporation, that they are having accounts receivable of $500,000 and they have sold it to a factoring company. Now the cash received from the factoring company have paid them $475,000, that is the immediate cash flow. And due from factor, which is $20,000, this is like factor hasn't paid this $20,000, but they have kept it as a security deposit with themselves, because in case $500,000 don't pay up, only some of them pay up, so factor always want to have some safety for them. So they have done a retention, or I can say deposit money with them for $20,000, which you can see held to cover returns, discount and allowances. And finally, if you add both of them, this will become $495,000. So remaining $5,000 belongs to the sale of loss on sale of receivable. Basically, this is the factoring fees or service charge. So if you see again, you have given your $500,000 worth of receivables to the factor company, and factor company has given $475,000 to you, and then $20,000 is kept by factoring company, not paid to you as of now. This will be paid at the last when entire recovery will be done from this accounts receivable. So this is just like a security to cover returns, discount and allowances. And finally 5,000 is the factoring fees or service charge. So what journal entry you will be passing? So you will say, your company will say that you have received a cash of $475,000. So you have received the asset and your cash is increasing, so you will be debiting them. And this $20,000 is due from factor. You can call it as security deposit, because you will receive it from factor at the end of factoring cycle. And this $5,000 is again your expense, so you debit these expenses because this is the fees for factor what you are paying for. And finally you have reduced your accounts receivable, because these are no longer belonging to you, these have get reduced. So this is the entire accounting entry which has been created, which is debiting the cash, which is increasing, your security deposit asset is increasing, and your expense is debiting, and finally your accounts receivables are crediting. Now the explanation for that stays like that cash is like amount received immediately from the factor. Due from factor, you can say this is retained by factor to cover potential returns, discounts and disputes, so they are keeping it as a security deposit. Then loss of sale is like factoring fees or service charge for converting receivables to cash. This is fees which factoring company earns. And accounts receivable are removed from Apple company's books since these are being sold. Now, if you see the same thing through the textbook definition, what we have understood through the example above, so definition simply says that a non-recourse sale of accounts receivable is final, and this within this the factor assumes all collection risk. The risk belongs to factor, that seller has no obligation if customer fails to pay. So within that, a lot of due diligence is being done, and due to that reason only, you can see 20,000 is being kept in the security deposit, because there may be some risk. If the debtors don't pay, then they will seize their security deposit and so on. So this is that. And then the accounting treatment is like journal entry when receivables are factored without recourse. So the journal entry, you can see the company, Apple company has received cash, so that is being debited. Then security deposit, which is due from factor company, this is our money. If the debtors do good, then this security deposit will be refunded to us, so this is debited. And then loss on sale of receivable, this is the factoring fees, we can call it as factoring fees as well. And finally we are crediting the accounts receivable, which is removing receivables from our sellers books of accounts. And due from factor is like this account reflects the retained proceeds held by factor. So this due from factor, this is the account this shows whatever security deposit or retained proceeds. This is the retained amount which they will be paying us later on if the things go well. If actual returns, discounts and allowances are less than retained amount, the balance is returned to seller. So just to understand this example, in our above example, the $20,000 we saw was our retained amount. So out of that $20,000, let's suppose the debtors has done a return or discount or allowance of, let's suppose, $2,000. Now this additional loss which the company is incurring is due to, I can say, discounts and returns. So how much factor company will pay at the end out of these 20,000 of deposits? So you will simply say that out of this 20,000 they will be paying only $18,000 because 2,000 has been used by them. Now the key final point is the seller loses title to the receivables. Why? Because these receivable now belongs to the factor for accounting purpose, but receivable receives immediate cash and before bears no further collection risk. So at the end, the storyline or the bottom line, which is like finally these money belongs to now the factoring company, and the Apple company who have sold their debtors, they receive immediate cash on account of that.